This isn't a scheduled meeting. Let me say that again so you feel the weight of what's unfolding right now. The Federal Reserve has called an emergency session tonight, not the regularly scheduled FOMC meeting coming up in a few weeks. Not a routine policy check, an emergency, closed-door session under expedited procedures, the kind of procedural switch the Fed doesn't flip unless something is already on fire. The last time the Fed moved outside its normal calendar like this, the global financial system was inches from a full stop. Banks were freezing, credit markets were seizing, the gears of modern finance were locking up in real time. That was the pandemic crash, March 2020, when the whole world could see the shockwave. Tonight, there's no pandemic, no obvious external event, no clean headline the mainstream media can package into a neat explanation. And yet, the Fed, still the most powerful financial institution on Earth, has decided the situation is urgent enough to warrant emergency action. That only happens when something breaks, something behind the curtain, something the public hasn't been briefed on, something the financial press either doesn't understand or doesn't have the stomach to report has gone wrong enough that the Fed can't afford to wait. I've spent the last 18 hours making calls, digging through filings, tracking overnight market signals, and stitching together the fragments that explain why this is happening now. What I found didn't scare me because of what the Fed might do tonight. It scared me because of what this emergency session admits about the real condition of the system, what they've been masking, smoothing over, and delaying. And it's exactly why your physical silver and gold matter more right now than they ever have in your lifetime. Futures are glitching and freezing. Bond yields are spiking in directions that don't make sense in a stable market. The overnight repo complex is flashing volumes that echo the worst stress since the September 2019 repo crisis. And in the past 48 hours, multiple major banks have quietly tapped emergency liquidity at the Fed's discount window. That isn't normal. That isn't market noise. That's a distress signal. And this is the moment precious metals holders have been preparing for. Tonight, I'm going to break down what triggered the emergency session, what the Fed is most likely to announce, and what it means for the dollar, for interest rates, for bank stability, and for the price of gold and silver. This is the most urgent video I've ever published. And by tomorrow morning, the financial landscape in America may look fundamentally different. Let me show you what happened over the last 72 hours that forced the Fed's hand. Let me walk you through the sequence the financial media either missed or chose to ignore. It started Friday afternoon. At approximately 3:47 p.m. Eastern on Friday, the Federal Reserve Bank of New York executed an emergency overnight reverse repo operation totaling $412 billion. Read that again, $412 billion, injected into the overnight plumbing in one operation. To put that in context, normal daily reverse repo levels over the past year have tended to sit in the $150 to $250 billion range. A $412 billion hit isn't a rounding error. It's a spike massive, abrupt, and unmistakable. Something demanded extraordinary liquidity late Friday. Something needed more than $400 billion in emergency overnight funding right before the weekend. And what did the New York Fed say? Nothing. No press conference, no explanation, no unusual market conditions statement. They posted the number on a website table, buried in routine operational data most people never look at. No context, no acknowledgement, but the number itself was screaming, something is wrong. Then came Saturday. On Saturday morning, three things hit almost at once. A confidential advisory went out from the Bank for International Settlements, the central bank of central banks, warning member institutions about what it described as acute settlement risk in U.S. dollar-denominated instruments. That advisory wasn't published publicly. Its existence was confirmed to me by a source who's been reliable before, and acute settlement risk isn't a casual phrase. Settlement risk means one side of a trade isn't delivering what they owe. When settlement risk becomes acute, it means failures are large enough and widespread enough to threaten the integrity of the clearing system itself. At nearly the same time, the Chicago Mercantile Exchange, the operator behind the futures complex where metals and rates are priced, issued a notice increasing margin requirements on Treasury bond futures by 30% effective Monday morning. Margin hikes of that magnitude are rare. Exchanges do that when they detect extreme volatility risk or counterparty risk, or both. And then the third piece, the one that ties this together, landed quietly. The Federal Deposit Insurance Corporation updated its problem bank list. No press release, no media call-out, just an update posted like it was routine. The list showed the number of problem banks rising from 63 to 77 in a single quarter. 77 banks. That's the highest count since 2021. And the total assets tied to those problem institutions jumped from $46 billion to $83 billion, nearly doubling in one quarter. Now, connect those dots, because together they tell a story the mainstream narrative is refusing to tell you. The settlement stress flagged by the BIS is concentrated in Treasury-related flows. Institutions that are supposed to deliver treasuries to counterparties aren't delivering. And those failures are clustering around banks that are trapped in underwater treasury positions. They bought bonds when rates were near zero. Since then, as yields climbed, the market value of those bonds dropped hard, down 20, 30, even 40% depending on duration. The banks can't sell without crystallizing losses that would punch holes through their balance sheets. But they also can't easily deliver into obligations without mark-to-market exposure that reveals the damage. This is the same core dynamic that took down Silicon Valley Bank in March 2023. Unrealized losses, maturity mismatch, fragile funding. But this time, the risk isn't isolated to one institution, or two, or three. The FDIC data implies it's at least 77, and the BIS signal implies the settlement failures are large enough to threaten the Treasury clearing infrastructure itself. That $412 billion emergency repo injection on Friday, that was the Fed trying to paper over the settlement strain by flooding the plumbing with liquidity, and it didn't solve it. The stress continued into the weekend, and by Sunday evening, the Fed appears to have concluded the situation is serious enough to justify emergency action outside the normal schedule. That brings us to tonight. The emergency session was posted as a notice on the Fed's Board of Governors website at 6:15 p.m. Eastern Monday. The wording mattered. It said the board would convene under expedited procedures to consider matters related to monetary policy and financial stability. That phrase, financial stability, is the tell. This isn't just about tweaking rates. This is about preventing systemic failure. Now let me explain what the Fed is most likely to do and why each outcome matters, especially if you hold physical silver and gold. There are a few plausible paths. One path is the dramatic one, an emergency rate cut something in the range markets are whispering about, potentially 50 to 75 basis points. That would be the largest single move outside a scheduled cycle since the pandemic cuts. And it would be an admission, whether they say it out loud or not, that conditions are far worse than the public story. It would directly contradict months of messaging about resilience, strong fundamentals, and a sound banking sector. For gold and silver, a sudden cut like that is rocket fuel. Precious metals respond to falling real rates. When the Fed moves aggressively, it signals easier money, and easier money is inflationary over time, even when they try to dress it up as stabilization. If the Fed shocks the market with an emergency cut, silver and gold can gap violently higher. But the cut itself isn't the main event. The signal is. It would signal the banking system is fragile enough to require emergency intervention. It would signal Treasury stress is severe enough to threaten stability. It would signal the Fed has lost control of the controlled demolition it's been attempting for 2 years. Another path is less theatrical, but just as revealing, an emergency lending facility. Instead of slashing rates, the Fed could announce a new program designed to keep banks alive despite unrealized Treasury losses, something structurally similar to the Bank Term Funding Program launched after SVB collapsed. The key mechanic in programs like that is simple. Banks borrow against Treasury collateral at par face value rather than market value. In plain English, they get to pretend the losses don't exist. The original program was sold as temporary. It was later shut down. If the Fed has to resurrect a successor, it means the core problem never went away. The underwater bonds are still sitting there. The losses are still sitting there. The fragility never left. A new facility might not cause the immediate fireworks of a huge emergency cut, but it confirms something equally important. The banking system cannot function without ongoing Fed life support. It confirms that on a mark-to-market basis, many institutions are insolvent or close to it. It confirms that the entire rate hike cycle has been riding on concealed damage. For precious metals, that's bullish, maybe not as an instant spike, but as a sustained narrative driver. Every temporary intervention becomes a precedent. Every rescue increases debt. Every emergency tool erodes confidence. And silver and gold thrive on lost confidence. There's also a blended path, what I consider the most probable, a moderate cut paired with a facility, plus forward guidance that signals more easing is coming. That lets the Fed address the immediate fire while trying to avoid looking like they're panicking. But here's the problem. The moment the Fed invokes emergency procedures, markets will interpret it as panic, regardless of how they spin it. The Fed does not call emergency sessions over minor issues. Those procedures exist for genuine emergencies. Using them tells the world something is seriously wrong. Now let me explain why this matters specifically if you hold physical precious metals. Tonight is a turning point, not just for interest rates, not just for policy, for the relationship between the government, the banking system, and the American people. For years, gold and silver holders were told they were wrong. Wrong about inflation, wrong about the banks, wrong about the dollar, wrong about needing tangible assets outside the system. Tonight, the Fed is admitting through action, even if not through words, that the system is more fragile than advertised. The banking sector is weaker than promised, and the policies they chose created vulnerabilities they can't easily unwind. Every emergency session validates the precious metals thesis. Every intervention confirms the system requires artificial support to function. Every bailout proves the normal rules have been suspended indefinitely. Your silver isn't just an investment. It's insurance against the exact kind of failure tonight's emergency meeting is trying to prevent. Now let's run the numbers. Let's talk about what these outcomes imply for precious metals, prices, the dollar, and your purchasing power. Start with silver. Silver is currently trading around the 75 per ounce area. Over the last year, silver has responded to meaningful policy shifts with sharp moves, often high single digits to mid-teens, within a matter of days. If an emergency cut hits tonight and the market treats it as the start of a cutting cycle, you could easily see a move toward the upper end of that historical response range. A 15% move from $75 puts silver around $86 within days. But the initial pop isn't the full story. After the March 2020 emergency actions, silver whipsawed, then launched, eventually rallying dramatically over the following year. The emergency action is the catalyst. The monetary expansion that follows is what sustains the repricing. If tonight marks the start of an emergency easing cycle, the path to triple-digit silver becomes less about if and more about when. Because the pattern is consistent. Emergency cuts lead to monetary expansion. Monetary expansion leads to dollar devaluation. Dollar devaluation forces precious metals to reprice. Now translate that into real terms. If you hold 100 ounces of silver, currently valued around $7,500, a move to $100 per ounce takes that to $10,000. That's roughly a $20,500 gain, about 33%. If you hold 500 ounces, about $37,500 at current pricing, a move to $100 takes you to $50,000. That's a $12,500 swing. If you hold 1,000 ounces, around $75,000, a move to $100 takes you to $100,000. That's a $25,000 repricing on what many stackers still consider a modest position. And those numbers assume $100 is the ceiling. It isn't. Look at what happened after the 2008 crisis, when the Fed moved into aggressive emergency easing. Silver surged from single digits to near $50 over the following cycle. I'm not telling you it must repeat exactly. I'm showing you the precedent of what happens when the Fed shifts from tightening to emergency intervention. That's history, not hype. Now gold. Gold is trading near all-time highs in the $3,200 region. If the Fed signals emergency easing, gold can push higher quickly. $3,400 becomes plausible in days, not months. And in a true easing environment, the path to $4,000 and beyond stops being a meme and starts being a probability curve. But the most important thing isn't the headline dollar price, it's purchasing power. Because if the Fed cuts tonight, it's rarely one and done. Emergency moves tend to start cycles. Historically, emergency episodes have been followed by additional scheduled cuts, sometimes deep, and every incremental cut changes the math. Each step down pushes cash yields lower. It increases incentives for leverage. It increases the temptation for money creation, and it reduces the real purchasing power of dollar-denominated savings over time, especially if inflation expectations re-accelerate. If the Fed cuts significantly over the next 18 months, purchasing power declines aren't theoretical. Your savings account doesn't protect you from that. Treasuries don't protect you from that. Money market funds don't protect you from that. Physical precious metals protect you from that. Because 100 ounces of silver you own outright doesn't require a counterparty to remain solvent. It doesn't require a functioning repo market. It doesn't require a bank to honor a promise. The dollar price adjusts upward as the dollar's purchasing power erodes. That's the purpose. Now consider the opportunity cost of not holding silver. If you keep $75,000 in a bank account earning 4%, and the Fed drives rates down, your yield compresses, your interest income drops. At the same time, if easing fuels inflation expectations, your real purchasing power bleeds out quietly month by month. Meanwhile, that same $75,000 converted into metal at today's pricing participates in the repricing that follows monetary easing. Instead of losing purchasing power, you gain it. The math isn't complex. The hard part is psychological detaching from a system that's designed to keep you dependent on paper claims. Tonight's emergency session is the signal. Now let me show you what tends to come next, because emergency decisions don't exist in isolation. They're dominoes. The pattern is familiar because the institutional incentives are always the same. Emergency action sends a message. Conditions are worse than communicated. Markets reprice. Volatility expands. Liquidity becomes selective. Then the messaging shifts. Officials start changing language quietly, at first walking back hawkish narratives, then scheduled meetings follow with additional easing once the emergency precedent has been set. Then the conversation turns to balance sheet tools again, asset purchases, liquidity programs, and technical measures that, in effect, expand money and compress yields. And when you combine lower rates, expanding support programs, and ballooning fiscal deficits, you create conditions for meaningful dollar weakness over time. A sustained drop in the dollar index tends to translate into higher nominal prices for real assets, including gold and silver, even without a supply shock. Then comes the repricing phase, the multi-month cycle where metals don't just spike, they reset. And we've seen versions of this play out repeatedly across recent decades. Not once, not twice, multiple times. Now let's address the predictable counterargument. You're going to hear people say, this time is different. They'll say the Fed learned lessons. They'll say banks are better capitalized. They'll say the economy is resilient. But the data doesn't support the talking points. Problem banks are rising again. Unrealized losses on bank-held securities remain a known pressure point. Consumer debt burdens are heavy. Delinquencies are climbing in key categories. Commercial real estate is still working through a slow-motion crisis in major metros. And when the system is truly strong, the Fed doesn't need emergency meetings. Emergency meetings exist because something is breaking, and now I need to address what won't be said out loud. The question the financial press won't connect. Why tonight? Why not wait for the scheduled meeting? Because there's a timing pressure the Fed doesn't like to discuss publicly. The Treasury Department has major auctions and funding needs on a tight calendar. The government must roll debt and issue new debt constantly to fund deficit spending. If market functioning deteriorates at the wrong moment, if auctions stumble, if dealer balance sheets tighten, if settlement failures widen, the consequences escalate fast. A weak auction isn't just bad optics. It's a signal of stress in the core funding engine of the U.S. state. And if settlement failures are creeping through Treasury plumbing, that process becomes vulnerable at the worst possible time. So the Fed acts, not necessarily because inflation requires it, not necessarily because employment demands it, but because the government must fund itself and the market must be kept orderly enough to absorb issuance. That's the uncomfortable connection. The Fed is portrayed as independent. In practice, the Fed and the Treasury are intertwined through the mechanics of funding, liquidity, and market stability. And when stability is threatened, the Fed moves. This is monetary policy in service of fiscal reality. And it's exactly why gold and silver exist as monetary assets. They can't be printed. They can't be conjured to cover deficits. They can't be diluted at a keystroke to make borrowing easier. Every dollar created to stabilize funding dilutes the purchasing power of dollars already in existence. Every policy move designed to prop up bonds changes the value of your savings. Every emergency session that rescues the system transfers purchasing power from the public to the machinery. Your silver is the antidote. Your gold is the hedge. They're the only assets in your portfolio that benefit from the policies that damage everything else. Tonight, the Fed will act to preserve stability. Tomorrow, dollars will likely be worth less at the margin, and hard assets will likely be worth more. That isn't a prediction. That's arithmetic. If you hold silver and gold tonight, understand what this emergency session is actually saying. You weren't wrong, you were early, and now the world is catching up. For years, metals holders were mocked and dismissed. You were told the economy was strong. You were told banks were sound. You were told inflation was transitory. You were told the Fed had everything under control. Tonight, the Fed is telling you through the most dramatic procedural tool it has that it does not have everything under control. Emergency sessions aren't called when things are fine. Expedited procedures aren't invoked when the system is stable. Hundreds of billions in overnight repo actions don't happen when the machinery is running smoothly. Everything you believed about systemic fragility is being confirmed in real time. You bought silver because you didn't trust banks. You bought gold because you didn't trust the dollar. You stacked metals because you understood the system is built on debt, leverage, and narrative management. Tonight, that foundation is cracking badly enough that it requires emergency repair. And I know being right doesn't always feel like victory. A lot of you are watching with anxiety, not celebration. Financial instability is frightening even when you prepared for it. Hold two truths at the same time. The situation is serious. This emergency session indicates real stress in the plumbing settlement issues. Bank fragility, liquidity strain. These are genuine risks that can create real disruptions. And you are prepared. Your silver doesn't depend on bank solvency. Your gold doesn't require a functioning repo market. Your metals don't need the Fed's permission to retain value. While millions of Americans may soon discover their deposits, retirement accounts, bond funds, and safe allocations are more vulnerable than they assumed, you're holding assets with a track record of preserving wealth through every crisis in modern history. That isn't luck. That's preparation. You chose real money over digital promises. You chose independence over dependence. Tonight validates that choice not just because the price may move, but because the emergency itself confirms the thesis. The system is fragile. Authorities are reactive, not proactive. And the safest assets are the ones you hold in your own hands. Don't dump silver into tonight's volatility. Don't panic. Don't second-guess the decisions that brought you here. The people who should be panicking are the ones holding nothing but dollars inside institutions. The regulators themselves are flagging as troubled. You are not one of those people. Act accordingly. So what should you do tonight and over the coming days? Avoid making precious metals transactions during the initial shock. When the Fed statement hits, metals can move fast and erratically. Spreads widen. Premiums jump. Dealer sites lag, crash, or halt orders. Let the first wave pass. The opportunity isn't catching the first candle. The opportunity is being positioned for the repricing cycle that follows. Review your allocation with brutal honesty. If this emergency session marks the start of a sustained easing phase, you want positioning before the full narrative shift becomes mainstream. The first day isn't the moment to chase. The window tends to appear after the initial shock settles and before the second demand wave arrives. Know what percentage of your net worth is in physical precious metals. If it's low, adjust with intention. Spread storage risk. If everything is in one place, remember, concentration risk applies to physical assets too. Consider multiple secure locations, home storage, private vaulting, trusted family distribution, whatever matches your risk model. Counterparty risk is real. Single point of failure risk is real. Reduce both. Strengthen your banking posture. Stress events can trigger runs. If you bank with a smaller institution, consider the practical reality that some banks will be hit harder than others. Know your FDIC coverage limits. Avoid excessive uninsured deposits at any single bank. Keep operating liquidity in institutions you view as structurally stable. Expect physical market tightness. Emergency Fed actions often ignite surges in gold and silver demand. Inventories vanish fast. Premiums can jump dramatically above spot. If you've been planning to buy, understand availability can become the constraint, not your conviction. Have more than one dealer relationship. Know what reasonable premiums look like before the headlines turn hysterical. Document everything. Know what you own, what you paid, where it's stored, and how you acquired it. In an environment of increasing financial surveillance and shifting tax enforcement, clean records protect you. Cost basis records protect you too, especially if metals reprice significantly higher. Manage your emotions. Headlines will scream. Social media will oscillate between doom and euphoria. Don't trade your nervous system. Make decisions based on fundamentals. The fundamentals haven't changed. Gold is money. Silver is money. The dollar is a promise. Promises can be broken. Metals can't. Share this information. Most people don't understand what an emergency Fed session implies. They don't know how the repo market works. They don't track settlement stress. They won't notice problem bank data until it's too late. They will learn eventually through withdrawal limits, portfolio drawdowns, or inflation at the register. Help them learn while they still have a window to prepare. I built this channel to give you analysis the mainstream financial media won't give you or can't. Tonight's emergency session is exactly the kind of event that demands independent commentary. The Fed is about to make a decision that touches every person in America, every dollar, in every account, every retirement portfolio, every mortgage rate, every loan, every price you pay. You deserve to know what's happening. You deserve to understand why it's happening. You deserve the truth about the system that controls your financial life. The emergency session begins tonight. By tomorrow morning, the world may look different. Make sure you're ready. Like this video if it helped you see what's coming. Subscribe if you want real-time updates as this develops. Hit the notification bell because I'll be publishing an emergency follow-up the moment the Fed's announcement drops. I'll see you in the next one. Stay sharp, hold your metals, and don't trust the system to protect you. It just proved it can't even protect itself.